Class, this is your week 3 knowledge check. So, few things. First, I want you to remember that asset accounts have what we call a normal debit balance. That means that in a T account, you should have been introduced to T accounts by now. You have the left side and the right side. The left side is your debit side, the right side is your credit side. Assets typically have a normal debit balance. So it has a balance on the left side. And liabilities and equity typically have balances on the credit side, so on your right side. When we look at revenues, revenues typically have a credit balance. Expenses typically have a debit balance. All right. So I want you to remember those constructs. The other thing to remember is that to increase an asset and to increase an expense, you make a debit entry. To decrease an asset or to decrease an expense, if you need to decrease an expense, you make a credit. All right. To increase your liabilities, to increase your equity, or to increase your revenues, you make a credit. And to decrease your revenues, if you need to decrease your revenues, or to decrease your liabilities, or to decrease your equity, you make a debit. So remember those concepts. Some other concepts that I want to quickly point out in chapter 3 is accrual versus cash basis of accounting. So we are looking at generally accepted accounting principles in this class. And so GAAP requires accrual-based accounting. So remember that. However, there is a cash basis of accounting. And that simply means that as cash comes in, then we record the transaction. As cash goes out, then we record the transaction. That is not permissible under GAAP. GAAP says we need to follow what's called the accrual basis of accounting, which means that when the substance of the transaction occurs, you need to record it in that period. When the substance of the transaction occurs, you need to record it in that period. So let's take, for example, a prepaid expense. All right. For a prepaid expense, you are prepaying for that expense up front. All right. So what you would do is you would make the entry when you actually prepay it. So a typical entry would be a debit to your expense account. Remember, because to increase expenses, sorry, I'm saying that wrong. You're not making the expense yet. You're not incurring the expense yet. You're just prepaying for it. So it's an asset. So you would debit your prepaid expenses asset account, all right, for the amount of the money that you've made, and you would credit your cash account because the only way to prepay is by cash. You can't technically prepay on credit terms, all right? You could potentially prepay for another asset, such as, I don't know, a vehicle or something. Not typical, not common. The way how you really prepay for an expense is through cash. So you would debit your prepaid expense account for the amount of the transaction when you prepay it, and you would credit your cash account to show that cash is going out the door. Now, when you actually incur the expense, you would debit your expense account for the amount of the expense, and you would credit the prepaid expense account to show that you're now using up that prepaid expense benefit. So let's take an example. An example is I decide to prepay for my insurance. All right. So some of you have car insurance and you know that you can pay monthly or you can pay all in advance, right? And if you pay all in advance, you typically get a discount. So let's say I decided to pay all in advance to get that discount. I would debit my prepaid expense insurance account for the amount of the money that I've paid, let's say $1,000. And then because I'm paying it in cash, I would credit my cash account to show that $1,000 is going out the door. Now, as the months go by, I'm using up that insurance benefit. So I cannot keep all that amount in my prepaid expense insurance account because I'm using up some of it. All right. So let's say next month is June and I'm going to incur $100 of cost for my insurance because it's $100 monthly. I would credit my prepaid expense insurance account for $100 to show that now I'm using that $100. And then I would debit my expense account for $100 to show that I've incurred $100 of expenses. All right. So that is how you would record that transaction. I promised that I would keep these pretty brief. So I'm going to quickly do an example of deferred revenue. So deferred revenue could be someone, again, decides to pay your company in advance. So, for example, the insurance company, when you pay for your entire policy up front, they have not earned all that revenue yet. So they have some deferred revenue, right? Same thing, if someone pays your company all the money up front, but you haven't delivered all the services yet, you have what's called deferred revenue. So what you would do is you would debit your cash account because the person is going to prepay you. They're prepaying in cash. And you would credit your deferred revenue account when you receive that cash. Now, when you actually deliver the services to earn that revenue, what you would do is you would debit the deferred revenue account to show that now you're reducing the amount of the deferment, and you would credit your actual revenue account to show that you've earned that revenue. And that's how prepaid expenses, deferred revenue work. And accrued expenses work similarly. So make sure you read the chapter. And if you have any questions, any concerns, feel free to reach out to me. Happy to assist. Thank you.